This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Mark Kritzman. Mark is a senior lecturer in finance at the MIT Sloan School of Management. He also happens to be president and chief executive officer at Windham Capital Management, and also serves as a senior partner at State Street Associates. He serves on the boards of the Institute for Quantitative Research in Finance and the Investment Fund for Foundations, and on the editorial boards of the Emerging Markets Review, the Financial Analyst Journal, the Journal of Alternative Investments, the Journal of Asset Management, the Journal of Derivatives, and the Journal of Investment Management. To his name, Mark has written 6 books. I love these types of conversations because Mark has been around the block. He has seen things. He has met people. He has come along over the last 3 to 4 decades to give a more unique perspective to all of us than, let's say, some young guy that only just started a few years ago. It's always nice to have the veterans on this show, the people that have spent time with the legends, the names that we all recognize. And Mark has had the good fortune to spend time with the likes of a Peter Bernstein, Paul Samuelson, an interesting career, an interesting perspective, a pure quant. I hope you enjoyed this conversation with myself and Mark Kritzman. Mark, I've got your newest book. I dive in, and right at the very beginning, I'm guessing you have some folks on Wall Street upset with your definition of what an asset class is. Because I think when you exclude things like hedge funds and managed futures, I'm sure some people say, hey, hold on, we are an asset class. Now, that's just kind of my opening salvo to kind of get the conversation started. You go quite in depth. We will never cover all of the depth that you cover in this newest work with your co-authors, not on this conversation today. So I implore people to check it out. But I think it's a good place to start with, which is really one of these questions that probably most investment professionals don't think about anymore. What is an asset class, right?
Well, I mean, that has got to be one of the most fundamental questions of asset allocation. If I were cynical, and of course I'm not, I might suspect that people want certain investment strategies to be classified as an asset class because that would mean that investors would feel compelled to allocate a certain fraction of their portfolios to that strategy. The definition that I put forth, I think, makes a lot of sense. I think it's certainly defendable on logical grounds. But the conditions are pretty straightforward. One is that an asset class has to have stable aggregation. Otherwise, have to monitor it and try to ascertain its appropriate composition, and it would require lots of rebalancing. So that's obviously one of the conditions. It has to be investable. You brought up hedge funds and managed future accounts. Of course, they're investable. It should be internally homogeneous. So that means that the components of the asset class should be similar to each other. And on that grounds, hedge funds and managed futures accounts certainly fail because hedge funds invest across many different asset classes and strategies. So it doesn't have that internal uniformity that you would expect from an asset class.
Can I interject there, though? You're not necessarily drawing a judgment as to whether the particular hedge fund strategy or managed future strategy is good or bad. You're just saying for the conversation of right now, defining an asset class, it just doesn't meet the criteria.
Yeah. The way I think about it, if you're doing asset allocation, there should be certain categories that you can invest in passively managed that are going to be the building blocks of your portfolio that are going to give you access to certain risk factors. And that's what asset classes do. I'm not critical of hedge funds by any means. I mean, we at our firm at Windham, we manage hedge funds. I think of hedge funds as a way of investing rather than as an asset class. And I think it's a very effective way of investing because it eliminates a lot of constraints that investors would have if they had insights, but they can only apply those insights within one group of investments. So, I think hedge funds are a great way of investing.
You make a great point there because I think so many times people get caught up in all of the particular manager or the fee structure and whatnot. But some of these hedge fund strategies have got great viability and have shown great results over a long period of time. But again, I'm interrupting here and I'm going to let you get back to the asset class definition first before we start venturing off into other territory.
Just to carry on with the attributes that qualify something as an asset class, I mentioned that an asset class, the components need to be similar to each other, but the asset class has to be different from other asset classes. That would mean it should be externally heterogeneous. If it weren't sufficiently different, then you could replicate it with combinations of other asset classes, so it would just be redundant. And then I think the most important attribute of an asset class is that it should be expected to raise the utility of a portfolio. So utility is a technical term, but it just means well-being. Another way of putting it, it should be able to either increase the return. Passive exposure to the asset class should be either be able to increase the return of the portfolio or reduce the risk of the portfolio without requiring selection skill on the part of the investor. So in other words, if you have to identify the top quartile managers of a particular asset class in order to improve your portfolio, then it's not an asset class. That requires selection skill. Selection skill is another requirement that an asset class should be able to improve the portfolio without requiring the investor to be able to select the best managers within that category. Finally, you should need to be able to access it in a cost-effective way. Otherwise, you wouldn't be able to raise the utility of the portfolio. People think about it, those are all very reasonable qualifications for a category that you're going to think of as a building block for your portfolio.
I'm assuming that to lay this foundation like you have, to really pick this point with the various hedge funds, managed futures that say, hey, we're an asset class too, you're really looking at this from the broadest application to the most investors. Let's get it down to bare building blocks. And then if somebody has their asset allocation mix in order and they're feeling good with it, if at some point in time they want to add a particular hedge fund strategy, well, then they could go that direction, sure. But it's like, let's agree on the basics first, right?
That's absolutely right. Let's decide what broad risk exposures you want your portfolio exposed to. You access those risk exposures through these building blocks that we think of as asset classes. And then once you do that, as you said, you can decide, do I want to access these asset classes using hedge funds or separate accounts or index funds, for example?
The asset classes that you have listed, for example, the cash equivalents, commodities, domestic corporate bonds, private equity, foreign real estate, several, about almost 20 around there, 18 to 20. This perspective, though, when you're describing the asset class, these asset classes, this is a long-only passive perspective. So the idea is, hey, let's see how we can, as you just mentioned, through the combination, the tactical combination of these various asset classes, let's see how we can do on our risk and our return through various combinations.
Right. You're going to come up, depending on your appetite for risk, you're going to come up with some combination of these asset classes. It could be a shorter list. It could be a longer list. This is just illustrative. But some combination of these asset classes that, again, are self-similar within each asset class, but different from each other, sufficiently different from each other that they're going to have the potential to improve your portfolio. So step one would be, if I were just to invest passively, what are the categories that I would want to invest in? And then you can think about, is there a potential to do better than passive management in some of these categories? And that's when you start thinking about actively managed portfolios and hedge funds and other vehicles. And then you can also think about, is there some advantage to using leverage to access some of these asset classes? I think of those is all secondary. They're more implementation decisions than the fundamental decision of what are the building blocks that I want to invest in.
Let me dig a little bit deeper here. Since you're kind of making this point very early in your work, we can both think of assorted folks on Wall Street that are not happy that somebody is laying down the gauntlet like this. But you must have really felt the need. Look, we're in 2017. You must have really felt the need that, hey, things have gotten too confusing. The average investor is overwhelmed. Let's bring this back to basics. Or speak to your thinking as to why you were really laying down the gauntlet here.
I've been involved in advising many funds over the institutional investors over the years. I look at how they stratify the world into their opportunity set for investing. And it just became clear to me that they were mixing ways of investing with asset classes. I just think let's do this in the cleanest, clearest, most basic way. Let's start there. It is mainly through my role as an advisor that I became interested in trying to organize the investment process in a way that I think was most logical, and mixing ways of investing with the building blocks that you want to compose your portfolio from, I think introduced a lot of confusion to the investment process.
There's something comforting about being able to at least define a piece of territory that we can all agree on.
I think you're exactly right. And it doesn't mean that investors shouldn't carve out part of their portfolio and say, we want to allocate this amount of money to hedge funds. They just, I want them to do it within the right logical framework. That's all. I agree with you that if we just step back and figure out, let's just start with the basics and move on from there, that does introduce comfort to the investment process.
Let me take you back in time a little bit, let you introduce some of your early background. You have been in, I guess, for lack of a better term, perhaps it was even before the term was used, you've had a quant perspective for quite a long time now, yeah? We're going back decades. You're not a babe in the woods here.
Unfortunately, I'm not.
That's always the most fun conversation because it's the guys that have seen so many different periods and so many different scenarios, and that's always the most fun.
It is. I think I've been pretty fortunate to have been born at a time that when I began my career, it was at the time when some of the academic luminaries of finance were developing their theories in those days, trying to interest practitioners in what they were doing.
Put a date on that for the audience, Mark, roughly.
I started my career in 1974. We think of Harry Markowitz as the founder of modern finance, and Merton Miller famously referred to his landmark article on portfolio selection as the Big Bang of modern finance. I think that's a very apt description. He wrote his article in 1952. He didn't do a lot. He's more of a philosopher and an intellectual rather than someone who had strong commercial leanings. So he didn't do a lot to promote it within the industry. But, Bill Sharp came along, and I think he actually did a lot of work to get people interested in his own work on asset pricing as well as Harry's work on portfolio construction. It took more than 20 years for the industry to come to terms with portfolio selection. It was something that was very new and unfamiliar to people. And I think it was helped a lot by two things. One was the passage of ERISA, which put a lot more onus on fiduciaries to diversify properly. Markowitz provided a formal framework for diversification. And then we had the epic market meltdown from 72 to 74. I think in inflation-adjusted terms, the sell-off in stocks was greater than what occurred during the Great Depression. People were losing confidence in their more, let's say, intuitive or ad hoc approaches to investing. The time was ripe for a new theory to be applied, and that was right when I was getting into the industry. I was young, naive, relative. I was a novice, but I was really taken with the elegance of portfolio theory and then capital asset pricing model. So I became really interested in it. So I guess if I look back on it, I think of myself more as a, in those days there was a semi-pejorative term called a token quant. So I was a token quant. And fortunately, in those days, you didn't need to be that strong in quantitative analysis to be considered a quant. I think most of the quantitative analysis that I've learned over the years has been through doing it.
But no, hold on. A token quant in the mid to late 70s truly would have been a token quant. I mean, you were like the guy on an island.
Yeah, I mean, every institute, most of the institutions had to have their quants to talk to the other institutions' quants, and I was one of those people, and we met with each other at various conferences, and it was a great time to start out in finance.
Let me pick your mind a little bit about some of your influences, and you can feel free to. You've mentioned a couple names already. You've mentioned Harry Markowitz. I've had the good fortune to have Harry on this show, and I've had the good fortune to meet Harry in person. I think I'm fair to say this, that he's just a sweet guy. I mean, obviously he's been brilliant, but he's a sweet guy, such a super nice guy. But I think there's another guy that I've talked about on this show before as well, too, which I loved because I picked up his book, Against the Gods, Peter Bernstein. That was my first introduction to his work. But why don't you speak to Peter some? Speak to his influence on you and perhaps share with the audience why he was such a giant in finance. And feel free to add a little bit about Harry as well.
Yeah, so Peter Bernstein and I were very, very good friends for many decades. I met Peter early in my career when I submitted an article to the Journal of Portfolio Management, which he published, thankfully. We had lunch after that, and we discovered that we both had homes near each other in Vermont. We developed a strong social relationship as well as a professional relationship. Peter had a huge, huge influence on my career. I mean, first of all, I've published so many articles in the Journal of Portfolio Management. I may have published more than anyone else, perhaps. I really had this ongoing working relationship with Peter. And then Peter, his main business was to publish a newsletter called Economics and Portfolio Strategy. He asked me if I would write one of those issues each year. I did for about 10 years. I had, right up until his death, I had the good benefit of having Peter edit these articles that I would write for his publications. Definitely learned a lot about how to communicate effectively. That's one of Peter's great skills, was he could really take complex ideas and describe them in a way that was accessible to just about anybody. He actually wrote the foreword to one of my books called Puzzles of Finance, and he wrote the foreword to another of my books called The Portable Financial Analyst. In addition, he introduced me to people such as Paul Samuelson and others, and I ended up developing a pretty good relationship with Paul Samuelson because he and I overlapped at MIT for a number of years before his death, and we developed a nice acquaintance thanks to Peter. He's had a great impact in my career, and if you look at Against the Gods, what you'll notice is there's a line in there where he thanks me for basically going through the book and checking all of the math and the math ideas that were in it.
I hope with all the nice things you have to say, I hope that spurs people to go check out his book. I think that was it mid to late 90s? Was it early 2000s when it came out?
Well, I'll tell you, I have it right here on my shelf, Against the Gods. 1996. Yeah, 1996. And I'm just looking at his...
I'd hear that nice female voice coming out of the background telling us 96.
Well, I have it right here, and there's a very nice inscription for Mark, generous friend, invaluable counsel, with much affection, Peter. You just couldn't ask for a better mentor than Peter Bernstein.
What I loved about that is a guy at the time, I was still wrapping my arms around things. I can pick up your books, Mark, and we're going to get dense and we're going to get deep really quick past probably the reading ability of a significant portion of the audience. That's just going to happen.
Yes.
What I thought was so nice about what Peter did, and Peter could probably get just as deep and dense as well, too. But with Against the Gods, he opened up. He made it a door that you could walk through and start to understand and start to think of risk, not just as an emotional gut, I don't feel good, I'm sweating now, but risk in terms of numbers. And that was so illuminating for me.
That and just the historical perspective of the evolution of risk measurement and risk management.
The evolution, absolutely.
He just made it such a compelling story. Even if you weren't interested in the content about risk, just reading about all of these famous mathematicians, how they influenced one another.
We've been trying to get there for a long time.
Yeah. He's just a great man.
That was what's so cool about the stories is he took all these stories going back across the millennia and connecting those dots and showing that humanity has been trying to figure out these puzzles for centuries.
Yeah, he did a great job with that.
Let me keep you at a name, though. You just mentioned another name that we're talking multiple names that would have been fun to chat with from an interview perspective. But Paul Samuelson, someone that I know a little bit about, not a lot. You're going to know way more than I do. But in your newest work, one of the things that I like where you use his perspective on time diversification. I think where he goes with time diversification is timeless for just about everybody. Time alone is not necessarily reducing your risk. The idea that you could be 20 and take crazy risks just because you think you have lots of time on your side. Well, the lots of time on your side, if you have a 90% drawdown, well, you've got more time to possibly recover. But just having the time alone doesn't guarantee anything.
Yeah, Paul Samuelson, in my judgment, is perhaps the greatest economist of the second half of the 20th century, possibly the entire 20th century. I guess you'd have to consider Marshall and Keynes in that category. But he was such a prolific writer. He contributed to so many different fields in economics. He was just a giant intellect. And I'm so grateful to Peter for introducing him to me, because the way it happened is that I was puzzled about Paul Samuelson's notion of the fallacy about time diversification. And I'll tell you how he came to think about this. He was talking to one of his colleagues. He offered his colleague a bet. The bet was such that his colleague was heavily favored to win the bet. And his colleague turned him down, and he said, Paul, I realize that I'm favored to win this bet, but I can't afford to lose the amount of money should I not win. And he then went on to say, he said, but Paul, if you allow me to make this bet 10 times, I'll take you up on that proposition. Samuelson went on to write this very famous paper called The Fallacy of Large Numbers. What his colleague failed to realize is that, yes, the likelihood of him winning on average over 10 independent bets is much greater than the likelihood of winning a particular bet, but he had to put up 10 times as much money. That offset, lower probability of losing, was offset by the greater magnitude of the potential loss. Samuelson wrote this very famous paper. He had a hard time convincing people about it. He actually, at one point, and I have this right here in my pile of papers, he was so frustrated about the inability of people to grasp his idea of the fallacy of large numbers that he wrote another paper that used words of only one syllable. Literally, the entire article had words of only one syllable except the last word in the article, which was syllable, at which point he pointed out that all of the prior words had only one syllable in them. It's very, very clever. But if you limit yourself to words of one syllable, it's even harder to understand what somebody's talking about. But in any event, the connection with Peter Bernstein is as follows. I wrote an article, needed to convince myself of what Paul was talking about, and I came up with a way of doing it by setting up a certainty equivalent and showing that expected utility did not increase as you invested over more and more periods. So that was basically, I think, a pretty straightforward, simple to understand way of conveying Paul Samuelson's insight. And I published this in the Financial Analyst Journal. And Peter Bernstein sent the article to Paul Samuelson. He liked it. And in fact, in a subsequent article that he wrote, he actually cited it favorably. It's unusual for Paul to cite things favorably. Usually he's pointing out other people's mistakes. That started a nice relationship with Paul Samuelson. This is, I know we're sort of veering away from the topic of asset allocation, but I'll tell you another story if you'll.
You're allowed to veer on this show. Sometimes the best things that happen when I talk to folks like yourself is the veering away.
Well, I'll tell you a couple of funny stories about Paul. Peter Bernstein, on the 30th anniversary of his publication, a group of people had a celebration in Peter's honor. There was a reception followed with a large number of people, including Harry Markowitz, for example, and then a smaller dinner afterwards. And I was one of the co-organizers of this event, so I arranged to have my wife and I seated next to Paul and his wife. I said to Paul, I said, there are a lot of stories about you. Do you mind if I ask you if they're true, or if you can shed some light on them? And he just, frowned. And then his wife said, oh, no, you must do this. One of the stories is that, Paul got his PhD from Harvard. One of the stories is that when he did his oral defense, after he did the defense, he was asked to leave the room so the committee could deliberate. The story is that one of the committee members looked at the other and said, do you think we passed? I asked Paul, is this true? He goes, well, I can't tell you because I wasn't in the room. And then he looks at me and there's this twinkle in his eye. He goes, actually, it was Leontief who said that to Schumpeter. I thought that was, he was just such a giant, as a student. He was, reinventing economics. The other story that I asked him about, it's about a footnote that's in this book called A Beautiful Mind. I don't know if you've read the book. Most people have seen the movie A Beautiful Mind about John Nash. Well, in the book, there's a footnote that has Paul Samuelson encountering Norbert Wiener on the MIT campus. And Norbert Wiener was a very famous mathematician. The Wiener process, which is a big deal in finance, is named after him. He was known not just for being a giant intellect, but also for being the quintessential absent-minded professor. The footnote in the book A Beautiful Mind has Samuelson and Wiener encountering each other, having a conversation, and then at the end of the conversation, Wiener turns to Samuelson and says, Paul, can you remind me when we started talking, was I walking toward the faculty lounge or away from it? Because in the former case, I'd not yet had my lunch. I asked Samuelson, I said, is this true? He goes, oh, yes. He says, but I have a better story about Norbert. He said, Norbert lived in the same town as I do, which is Belmont, Massachusetts. It's one of the western suburbs. While teaching at MIT, he moved from one house in Belmont to another house in Belmont. And shortly after he moved, he drove home from school one day to his former house, not remembering that he had moved. And he walked up to the front door and he put the key in the lock, and it didn't work. And then all of a sudden it dawned upon him that, that's right, he moved, but he couldn't remember where he moved to. And he looked down and he saw on the sidewalk this little girl standing there. And he said, excuse me, little girl, do you know the Wieners? Can you tell me where they moved to? And she said, yes, Daddy, Mommy said you'd be here. So anyway, hearing this story from this giant intellect like Paul Samuelson was a real treat.
Let me see if you can add any more color. I'm always curious about an aspect. I know little bits, and you've just shed more light, but I know little bits about Paul Samuelson. And I think one of the most intriguing things from my perspective is the investment firm that he helped set up. I still find that story absolutely fascinating because Commodities Corporation, if Commodities Corporation did not exist, Jack Schwager could not write the first Market Wizards book. And so you have this academic heavyweight, as you describe, potentially the leading economist of the late 20th century. And then you've got this situation where he said, you know what? I've got all these traders that have figured out assorted edges and they're doing really well. I can only imagine that Paul did exceptionally well from Commodities Corporation. Did you ever have a chance to share any insights about that venture with him?
No, we never did talk about that. Mainly, we talked about his research. Didn't talk much about any of his business associations. Maybe just in passing, you might mention one thing or another.
You knew about Commodities Corporation.
Yeah, but it's not something that I paid a lot of attention to. I was more interested in Samuelson for his intellectual contributions to the field of finance. More of a scholar than as a practitioner.
I always find it really fascinating that, he kind of was wise enough to go down both paths. I found that fascinating. But speak to a little bit more, though, as well on the time diversification part, because I really think that's something to hit home on to even the general investing public, the layman, and the utility aspect there. Because if you make the decision to make XYZ heavy bet at age 50 and you put aside and lose 50% of your net worth. This gets back to why we were defining at the very beginning of this conversation, asset classes, how can we get the combination, get the best results, etc. It's just not hit home enough in the modern conversation.
It's not. And I think there's, for a variety of reasons, people, there's a lot of misleading notions about the relationship between time and risk. So Samuelson's idea is that expected utility, which is, you can think of utility as just a measure of happiness or well-being, remains constant as a function of time. The way I try to explain this in the book is I use the notion of a simple gamble where there's a coin toss, and you invest $100 in this coin toss, and if it comes up heads, you gain 1/3, so you get $133. And if it comes up tails, you lose 1/4, so you get $75. Potential gain is $33, and the potential loss is $25. So it's a positive expected return game. What I showed is that particular gamble conveys the exact same amount of utility or happiness or well-being as having $100 for sure. An investor with a particular utility function called a log wealth utility function would be indifferent between holding $100 for sure or engaging in a gamble that had a 50% chance of a 1/3 gain and a 50% chance of a 1/4 loss. What I showed is that if you repeat this gamble over multiple periods, although the expected return continues to rise, that the utility remains the same. So that's the notion that time does not diversify risk. Now, the reason people think that time diversifies risk is because volatility, annualized volatility, goes down with the square root of time. And what that means is that the likelihood of losing money for a particular investment also goes down with time. What people fail to recognize is that although the probability of losing money goes down as you invest over longer horizons, the amount that you can lose goes up with each period that you invest in a way that is offsetting. That is the fallacy of large numbers. So what that means is that risk does not go down over time, but what Samuelson did acknowledge is that younger people have more human capital than older people, so they have more years to either change their consumption behavior or their work habits, so that if they experience a loss, a younger person is in a stronger position to offset that loss than is an older person who perhaps is retired and doesn't have as many years to adjust his consumption and work habits. Time doesn't diversify risk, but human capital does justify the notion that younger investors should be more willing to accept risk than older investors. But to your point, I think people really underappreciate their exposure to loss, because most of the finance literature thinks of risk as the distribution of outcomes that occurs at the end of some horizon. So if you have a 5-year horizon and they say, what's the likelihood that this investment strategy is going to lose 10% or more, they'll look at the potential paths of this investment strategy and say what fraction of them are below 90, assuming you start out with 100, and you'll see that it's not very many. The likelihood of losing 10% over a 5-year horizon might be around, for a typical 60-40 portfolio, it might be somewhere in the neighborhood of about 5%. But if you ask yourself, what's the likelihood that this strategy could be down 10% at any point throughout that horizon, assuming that you monitor your investment continuously, that probability, instead of being 5%, is greater than 50%. And people don't pay attention to that.
That point you make there, though, so key when you start to talk about leverage, because if you think that you can goose it up and apply all kinds of leverage and not think that there could be a drawdown early on in that period, then boom, then you're in real big trouble.
Yeah, that's exactly right. The reason I got interested in this is because I remember I was advising a foundation in New York many years ago, and they wanted me to help them come up with an asset mix that would have a very low probability of generating more than a 20% loss over a 20-year horizon. I remember sitting in this meeting and I said to them, so what you're telling me is that you're going to meet with your investment committee just once, and it's going to be at the end of the last day of the 20th year, because you don't care if you're down 20%, say 2 years from now or 1 year from now or 10 years from now. You only care about what's going to happen at the end of 20 years. Institutional investors all like to say that they have they're long-term investors and that they can tolerate interim drawdowns. But that, in my experience, that's just not true. What happens is that when there are large drawdowns, people become nervous.
Career risk plays a role there at some stages.
There is real risk. I think, you think about the financial crisis and think about Harvard University. They, as you may recall, suffered huge losses. They had a very illiquid portfolio. They had to go out and borrow to meet some of their commitments. They lost faculty. They postponed the development of this new campus for years and years. It had lasting impact on the well-being of the university. So what happens along the way is something that people should pay attention to and not just think you can look past that to the end of some distant investment horizon.
And doesn't it strike you as well, as a professional in the industry for literally decades, when institutional investors in, let's just say 2017, are talking about keeping their total drawdown or total loss at 20%. I mean, that just seems like, if you look at just the course of market history over the last century, I don't know where you would pull 20. What hat does 20%, only 20% down come from? What hat do you pull that from?
Yeah, well, you're right. I mean, I guess what you can think of is, if you're talking about a broadly diversified portfolio, a 20% loss would be a huge loss. If you're talking about the stock market, then you're right that potential losses are much greater than 20%. And people really just misunderstand their exposure to loss. The other thing is that following the financial crisis, there was a lot of talk about how quantitative methods failed, and we need a new approach to investing or to managing risk. That's just not true. They didn't fail. The naive application of certain methods produced unfavorable results.
But can I translate there? When you say the naive application, you mean a bunch of young salesmen on Wall Street sold something?
No, I think that investors did not make a realistic assessment of their fund's exposure to loss. Let me give you an example. One of the common metrics used to measure exposure to loss is value at risk. The way to think about it is, at a given probability, say at a 1% probability, what's the worst that can happen to my portfolio? So if you did this, if you measured value at risk conventionally, and I would say simplistically, prior to the financial crisis, and the way you would have done it is you would have said, let me look at the volatility of this portfolio based on its full sample of returns, and let me calculate value at risk as of the end of some horizon, say 5 years. What you would have said is that the worst that can happen at a 1% probability is that this, say, broadly diversified institutional portfolio could lose as much as 10%. So if you experienced a once in a century bad outcome, the worst that could happen to this portfolio is that it would go down 10%. I wrote a piece prior to the crisis. It may have been for Peter Bernstein, I can't quite recall. And what I showed is that the way you should think about exposure to loss is not to base the portfolio's volatility on the full sample of historical returns, but base it on the subset of historical returns that occurred during turbulent market environments, because most losses occur when markets are turbulent and not when markets are calm. If you measure your portfolio's risk based on the subset of periods when losses are more likely to occur, you're going to get a very different measure of the portfolio's volatility.
100-year window would just dilute it, so you're not really giving yourself useful data.
Here's a good metaphor or analogy. I live in Boston. The average temperature in Boston, I think, is 52 degrees. If I had my wardrobe was designed for 52 degrees, most of the year I'd be very uncomfortable. I'd either be very cold or very hot, right? And that's the way, if you look at the full sample of returns and, you're looking at what the average risk is, that's going to obscure the kind of risk that you're exposed to when markets are turbulent. If you estimate your portfolio's risk based on the subsample of history when markets were turbulent, and if you estimate your exposure to loss based on what can happen throughout your investment horizon as opposed to just at the end of your investment horizon, then the value at risk of this portfolio, instead of being 10%, would be shown to be 35%, so that a once-in-a-century outcome would produce a 35% loss. I published this in 2006, and then the crisis came. I sort of forgot about it, and then after the crisis, somebody reminded me of it, and I went back and I said, what did this portfolio do in the crisis? And it turns out it went down 35%, which is not to say I predicted the portfolio would go down 35%, but it's to say that, if you're going to have a once-in-a-century bad outcome, this is how bad it's going to be. Just making those kinds of adjustments to the way we measure exposure to loss goes a long way in giving investors a much more, I think, realistic.
You're being nice there when you call that an adjustment. I mean, that's almost like that kind of a change is almost from a mindset and a technique is almost like open heart surgery. I mean, 10% to 35%, that's quite an adjustment though, huh? You're being nice. You're being kind.
It is a huge adjustment. The financial crisis was just a really traumatic experience and caused a lot of pain and suffering to many, many people. One of it's hard to describe any silver lining, but one silver lining is it sort of wiped the slate clean, and instead of people just dealing with risk measurement and portfolio management and just incremental innovations, it really, I think, provided a context in which people could just go back to basics and really think about how to get more sophisticated, pay attention to real-world complexity. I mean, I think part of the problem with the way finance has been studied in academia and applied in industry is that people have relied on a lot of simplifying assumptions to get tractable solutions that can be arrived at using clever analytical methods. Although it's nice to have all of this mathematical elegance, it doesn't necessarily get you closer to the truth. And I think what the financial crisis has taught us is that we really need to deal with a very messy world and recalibrate how it is that we measure and manage risk.
Since you're taking the audience back to that point in time, which I think for so many people still feels like yesterday, 2008, 2009 is 2017. Give me your best learned perspective, not a prediction about where markets are going to go, but give me your best learned perspective in terms of where the risk might lie for the next unknown meltdown that will surely come. Because, I mean, how many different meltdowns have you seen in your career? Quite a few. What are you seeing? What are you feeling across practitioners, across Wall Street that's good right now? Good adoption, good technique? And what is going on perhaps under the hood that we can all think about, that when the next bad period arrives, we might look, perhaps even some of your wisdom right now might say, gosh, people were thinking about this in advance?
It's a great question, not necessarily within the realm of my expertise, but I won't let that deter me. I think what's positive is that financial institutions are better capitalized than they have been. I think some of the regulation that's been passed has made the world a bit safer. I think that there's sort of a dark side to the regulation, that there's just a lot more inefficiency and cost that's been inserted into the system. That's a bit of a problem, that there's just a focus on complying with rules that I think may not actually serve any positive purpose. One thing that I think hasn't changed and probably never will is this notion of fear and greed. When times are turbulent and chaotic and there are losses, people become very fearful and very reluctant to take on risk. When times are good, when we have rising markets, people are reluctant to take risk off the table. And I think today that's where we are. I think it's not I don't think it's as great a bubble as we've had in some of the past episodes, but I do think we have to start worrying about valuations and the potential for large drawdowns should there be some kind of a shock, whether it's a geopolitical shock or an economic shock.
But as you just set that up by stating greed and fear, the fact that there will be another shock or there perhaps could be another bubble, this is not new. This will, as long as we are human beings, this will continue, wash, rinse, repeat. We will continue to have these periods. And I think the hardest part will be, and I appreciate that you're very pragmatic about this, very quantified. We just don't know. All we can do, and I think what you lay that foundation with your newest book, and I'm sure with your other books as well that I've not seen, but it's just to kind of ground ourselves to the best we can to think about the risks and the rewards, right? Because there's no guarantees here. All we can try and do is, frankly, minimize the downside and hope for some good upside.
Yeah, I guess what I worry about is that most institutional investors believe that we are in a very low expected return environment with interest rates so low and equity valuations so high. And many institutional investors are faced with return requirements that far exceed their return expectations. What that means is that in order to try to achieve those required returns, the investors have to take on more and more risk. And I think that's partly what we're observing today. One point I'd like to address is this notion of a policy portfolio. And this takes us back to Peter Bernstein. One of the insights that he had late in his life, he put forth the proposition that policy portfolios were obsolete. The way I think about this is investors, whether you're an institutional investor or a private investor, investors want two things. They want to grow their wealth and they want to avoid large drawdowns along the way. And a policy portfolio is designed to balance those two conflicting goals. They conflict because the more you design a portfolio to grow, the more you expose it to drawdowns. But investors don't necessarily want the specific asset mix of a policy portfolio. What they want is the return distribution that they expect that policy portfolio to deliver. The problem with a policy portfolio, which is a portfolio of fixed weights, is that it produces a very, very unstable risk profile. So you think of the typical institutional portfolio going into the financial crisis, its trailing annualized standard deviation of monthly returns over the prior year was about 3%. Very, very low. Volatility, equity, VIX was around 8% going into the crisis. A diversified portfolio had trailing volatility of only about 3%. Coming out of the crisis, its trailing one-year volatility of monthly returns was 30%. That gives you a sense of just how unstable the risk profile is for a portfolio of fixed weights. Now, the crisis is an extreme example, but even if you take that out, the volatility would range from 3% to, say, 15 or 20%. Hugely unstable. What Peter proposed the notion that having a policy portfolio is not necessarily a good thing. He said, perhaps what makes more sense, rather than have a portfolio of fixed weights that delivers a very unstable risk profile, have a flexible investment policy that delivers a more stable risk profile. And I think this is where a lot of investors are headed today. They've come to the realization that a portfolio of fixed weights introduces a lot more instability than they had anticipated, and that they need to be more dynamic in how they manage their assets. And not market timing has sort of a pejorative connotation. I think the industry sort of got around that connotation by relabeling market timing as tactical asset allocation. And now I think you can even refer to it as just risk management. But I think it is, I think Peter was onto something, that it may be more prudent to have some kind of structured or disciplined approach to rescaling your portfolio's risk so that you're attempting to maintain a stable risk profile, having variable weights that produce a stable risk profile rather than inflexible weights that deliver an unstable risk profile. So I think where we're headed is in a world where there's going to be a little bit more dynamic asset allocation than rather instead of having very rigid policy portfolios.
It's music to my ears. I like to hear someone like yourself say that. I'm always inspired by those folks that have the flexible mindset in their portfolio choices, because I think you're right. Most people will lock into something, and then that's whether that's on the retail level or the institutional level, and then that's just it. And the world is more complicated than that. And the techniques that have evolved, the understandings that have evolved, there's more tools to be used that are just better than what was available in past time periods.
I think that's true. And if I can make one final comment, is there's I think a solid theoretical argument in favor of dynamic asset allocation, which was put forth by none other than Paul Samuelson, and it's referred to as the Samuelson dictum. And what Paul argued is that markets are relatively micro-efficient and macro-inefficient. What that means is that it's easier to be successful at asset allocation than it is to be successful at security selection. The way he reasoned is that he said, if there's a particular company that's mispriced, some smart investor will notice this and will trade to take advantage of that mispricing. And by trading, will correct the mispricing. So mispricings of individual companies are very fleeting and hard to take advantage of by many investors. Whereas if an aggregation of companies, such as an asset class, is mispriced, and a smart investor notices this and trades to take advantage of it, that investor will not have the scale to revalue an entire asset class. And so typically the asset class will remain mispriced until there's some kind of exogenous shock that jolts many investors to act in concert to revalue that asset class. So these kinds of macro inefficiencies tend to persist for longer periods of time, thereby enabling investors to take advantage of them. So, I think there is something to be said for dynamic asset allocation. And as you mentioned, there are a lot of new tools that people are developing to do this kind of work, and I think it holds a lot of promise.
Mark, we could go on for a long time. I just scratched the surface of your newest book. We've talked about a lot of other books that people should check out, other individuals for sure, from Peter to Harry to Paul, all great names that if people are unfamiliar, they should go dig in for sure. Your newest book, The Practitioner's Guide to Asset Allocation, some of our early part of this conversation, you bring up the questions. You bring up and say, hey, let's discuss this in a balanced way. Let's try and put the emotions to the side. Let's think about some basics that we can all agree to. Good directions. I appreciate you coming on today. Is there any place we can send people to check beyond Amazon? They can go to Amazon and start to buy books. But is there any particular website that you would like to have my audience go to check out more from you?
I think the best place to go would be our website, which is called windhamlabs.com. There's a lot there about our research and our publications. We would welcome people to take a look at that.
When I make it to Boston, for sure, I would love to grab lunch someday and chat. I'm on the other side of the world right now, but appreciate you taking the time today, Mark.
I appreciate you having me. It's been a lot of fun talking to you. You've really posed some great questions.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.